Gold investors. Gold at 5,000 isn't a bubble, it's a diagnosis. The metal isn't going crazy, the currency system measuring it is quietly breaking, and this price is just the symptom finally showing up on the screen. I'm OG John AG, and in this video I'm going to show you why a 5,000 gold print with 77 silver is not peak mania but early stage repricing, how the gold-silver ratio and physical metrics prove silver is still brutally undervalued, why an analyst with a documented track record is calling for 180 silver, what the COMEX, COT, and Shanghai data actually say about paper versus physical, and how to think like wealth preservation money instead of a short-term speculator in a sick currency system. Segment 1, Gold 5,000, Bubble, or Diagnosis. Current snapshot, Western silver spot around $77, futures at 77, Shanghai silver spot about 86, futures 88, a $9 premium. Western gold spot around $5,043 after a historic weekly close above 5,000. People see that and ask, is this peak gold, peak silver, a mania? Short answer from this video, no. This isn't a bubble in metals. It's the symptom of a currency system that's been sick since 1971, now shifting from slow breakdown to fast. Gold and silver are not going to the moon. Fiat is going into the basement, and the metals are just staying real while the measuring stick shrinks. Segment 2, Gold-Silver Ratio versus Physical Reality. Headline numbers from the video, Gold-Silver Ratio, screen, 65.1. You need 65 ounces of silver to buy 1 ounce of gold. Historical Monetary Ratio, roughly 15.1. Physical and structural ratios. COMEX Vault Reality, about 111, 1 ounce of registered gold value versus 11 ounces of silver value in their system. Mining ratio, around 1.8, 8 ounces of silver mined for each ounce of gold. LBMA vault ratio, roughly 1.3, available above ground monetary metal, effectively 1.1 in value terms. So you have screen ratio 65.1, monetary history 15.1, physical mining reality, between 8.1 and 3.1, down to 1.1 in above ground terms. The video's point, every metric says silver is undervalued versus gold by 4x to 11x, depending on which yardstick you use. That spread can only resolve in two ways: permanent revaluation of silver upwards, or the biggest arbitrage opportunity in the commodity complex for those who act before the mechanism flips. This is the opposite of silver is expensive at 77. It's silver is mistagged by the paper system. Segment 3, Prince's $180 call and why it matters. The video highlights Prince, an analyst with a public record of big calls, called 2,500 gold, and it hit, called 3,000 gold, and it hit. Now calling for $180 silver by year-end from around 77 now, a projected 117% gain despite volatility. This isn't random YouTube hopium. These calls are documented, time-stamped, and checked against reality. The point is not that 180 is guaranteed, but that people who were right on the last major moves are still extremely bullish, not calling a top. When an analyst with that hit rate is leaning into triple-digit silver while mainstream says bubble, you need to at least ask, what do they see that the crowd doesn't? Segment 4, COT, managed money dumped, just like before the last big run. Look at the commitment of traders, COT report, free CFTC data every Friday. The video notes, managed money long positioning in silver has evaporated. Current net long levels are back to where they were in February 2024. What happened after February 2024? That's when managed money was massively short right before the biggest dollar move higher in silver. Takeaways. Managed money, hedge funds, CTAs, trend chasers often acts as a contrary indicator at extremes. When they dogpile one way, the smart money often quietly takes the other side, knowing crowd psychology overshoots. Today, silver is at 77. Managed money has bailed or flipped near flat short. That's the same setup as right before the last giant move, not the setup you see at the top of a bubble. Segment 5, Shanghai plus SGE. Stockpiles nuked, premiums high. Physical demand in the East is ignoring the paper drama. The video lays out brutal inventory math, combined SHFE plus SGE, Shanghai futures and spot. Silver stockpiles are down about 90% over 6 years. They're down roughly 50% just since 2025. At the same time, Shanghai silver trades at about a $9 premium to Western spot. Those two facts together mean Chinese and other Eastern buyers are draining available metal. They're willing to pay significantly above COMEX LBMA official price to get it. This is the heart of the thesis. Futures can be smashed in thin windows, especially when Shanghai is closed. But long-term physical demand sets the real floor, because you can't run factories, militaries, or grids on screen prices. Segment 6, Silver. Now officially a critical national security metal. The video goes further. The US has declared AI a matter of national security. The US has declared silver a critical mineral, and strategic analysis says they are considering stockpiling it. Why? Silver is essential for AI data centers and high-end electronics, military applications, guidance systems, communications, weaponry, green energy infrastructure. When a metal becomes a national security input, the priority shifts from what's the price to do we have enough? Market economics get overridden by security economics. Buying becomes price insensitive at the sovereign level. Add China to this, largest consumer and exporter of refined silver, has implemented export controls, and the video expects those will tighten if domestic supply is threatened. So you have the US wanting to stockpile, China potentially restricting exports, 70% of silver coming as a byproduct of other mining, which doesn't ramp just because silver's price rises. That's not bubble conditions. That's a strategic choke point building. Segment 7, peak silver supply and structural deficits. Supply isn't keeping up. We're in structural deficit territory. The video notes, peak silver supply was around 2016. Roughly 70% of silver production comes as a byproduct of mining lead, zinc, copper, etc. We've had 5 consecutive years of deficits, consuming more silver than we produce. Crucially, a zinc or copper mine doesn't double output just because silver gets expensive. If the primary metal economics don't justify it, silver byproduct won't surge. So, demand rising from AI, defense, solar, EVs. Supply constrained structurally. Above ground stockpiles in the East down 90% in 6 years, 50% since 2025. Again, that's not a blow off top. That's a classic tightening physical market where paper price hasn't fully caught up. Segment 8, gold 5,000 with falling ETF holdings. We're early. This is one of the most important segments. The video points out gold has tripled from about 1,900 to 5,000. Yet physical gold ETF holdings, GLD and others, have not returned to their 2022 highs. In fact, retail and many institutions have been selling ETF shares while price tripled. Who's buying? Central banks and wealth preservation clients accumulating physical bars, not paper ETF claims. Retail allocations to gold are still under 1%. Interpretation. This is not speculative mania. This is a fundamental revaluation being driven by official sector and sophisticated wealth, while the crowd is either absent or selling. That's why the video says, gold is cheap, we are early, bubbles happen when everyone is in. Right now, almost no one is. Segment 9, the sick currency system, why metals look high. The core thesis, gold 5,000 is not terrifying. The dollar and fiat system behind it are terrifying. Key points. Since 1971, every political stripe has run deficits well beyond sustainable levels, assuming the Fed will mouse-click money to save the system. Currency debasement, printing to monetize debt, and weaponization of the dollar as a sanction tool have accelerated distrust. Official inflation numbers underreport the real loss of purchasing power. The public is being robbed slowly via negative real returns. Author cited, Adam Ferguson, When Money Dies, shows Weimar citizens who held physical assets survived while paper promises evaporated. Charles Mackay, Extraordinary Popular Delusions and the Madness of Crowds, Documents Bubbles and Mass Psychology. Ray Dalio, Principles for Navigating Big Debt Crises, explains how systems with too much debt end up deleveraging via debasement or default. We're now in the phase where fiat is losing credibility by 1,000 small cuts before the exponential loss of trust. Policymakers are boxed in. Save the bond market by printing, kill currency, or save currency by crushing bonds, growth, and employment. The video's view, they will not sacrifice the bond market. They will sacrifice the currency and spin the story to blame external villains. Gold and silver are simply recording that choice in real time. Segment 10, why metals are hated, the red warning sign. The video talks about a metaphoric red sign governments hang over gold and silver that says, do not invest here. That sign looks like extra taxes and reporting burdens you don't see on stocks. Extreme volatility, much of it artificial, that scares retail away. Social stigma, stackers being called crazy or doomers. Most people give up because they only think in terms of making more dollars. There are easier ways to get short-term dollar gains, tech stocks, meme trades, options. The only ones who stay are those who see creeping authoritarianism and uncontrolled debt as real risks. Understand physical gold and silver as tools to preserve liberty and purchasing power, not get-rich-quick tickets. That means paying premiums to get out of the system, watching the official price get smashed with no good explanation, getting laughed at by bankers, friends, and family, until 2025 when they stopped laughing. Segment 11, Bear Case, Why Risk Still Matters. This isn't one-sided hype. The video explicitly covers the bear arguments. Gold at 5,000 is parabolic. Parabolas do correct. Silver at 77 has not reclaimed certain key resistance levels, so technically it's still vulnerable. $180 silver calls, even from good analysts, are forecasts, not guarantees. Assuming the gold-silver ratio will revert exactly to 15:1 is just that, an assumption. Markets don't owe us symmetry. Managed money being a contrary indicator doesn't tell you exact timing. Extremes can persist longer than you think. COMEX has contained delivery pressure for decades using rollovers and forced cash settlement. Paper manipulation has survived many stress tests. Wealth preservation strategies work for those with wealth. They don't magically help someone trying to 10x a small account overnight. This is financial warfare education, not buy now, get rich tomorrow advice. Segment 12. Bottom line, how to think about this moment. The video closes with a checklist of what the data actually shows. Gold-silver ratio 65 versus historical 15 and physical metrics, COMEX 111, mining 1.8, LBMA 1.3, above ground 1.1, all screaming silver is underpriced. An analyst who called prior major gold moves is now forecasting 180 silver from 77. COT managed money positioning back to February 2024 levels, just before the last big silver launch. SHFE plus SGE silver stockpiles down 90% in 6 years, 50% since 2025, while premiums stay elevated. Physical demand strong, with the U.S. declaring silver a critical mineral and AI a national security priority, and China controlling exports and tightening when threatened. 70% of silver as byproduct means higher prices don't automatically create a flood of new mine supply. Gold at 5,000 with lower ETF holdings than 2022 shows central banks and sophisticated wealth buying while the crowd is absent. Your job is not to worship these facts. Your job is to verify them and then decide, do you treat gold and silver as speculative trades on price? Or as money and insurance in a system where the real bubble is debt and fiat? You've been watching John AG here, and I'm OG John AG. If this helped you see why Gold 5000 is less about a metal going crazy and more about a currency system rotting from within, hit like so this kind of data-driven breakdown doesn't get buried. Subscribe and turn on all notifications. Because the real question isn't whether 5000 gets a pullback, it's whether you'll be positioned before physical reality, not paper games, sets the next price.